every 2 weeks or whatever it was. But when you went to the store, over time, prices kept getting lower and lower. Okay, so that certainly is good from the point of view of the worker who keeps his job, but the perverse outcome, the unintended consequence, was that if a firm goes out of business, lays off its workers, those workers had a much harder time getting hired by somebody else, because as time passed, their actual pay, the pay demands kept getting more and more expensive. From the employer's point of view, their sales kept dropping. How much they made in selling their products kept going down over time because of the shrinking money supply and prices were falling, and yet they had to keep paying the same dollar amount to hire a worker for a given hour, for a given salary. Okay, so you can see that's labor economists studying this period pick one thing and say, why was it that unemployment went up to 25% under the Hoover administration? That's the reason they'll give, is that because he had this perverse policy. He thought he was helping, but he wasn't, by saying to businesses, don't cut wage rates. Okay. In contrast, if you go back to, say, the 1920 to 21 depression, which happened in the U.S. following World War I, again, it was a pretty sharp recession. Unemployment went up to about 12% because troops were coming back from World War I. The government cut its budget very severely, and the Federal Reserve raised interest rates because they had had wartime inflation. So it was a pretty severe recession. Unemployment went up to 12%, like I said. But by 2 years later, unemployment was down to under 3%. And of course, the 1920s was called the Roaring Twenties. It was a booming decade of prosperity. And so you say, well, how come? And another thing is prices also fell even more sharply during the 1920-21 depression than they did during the Great Depression. And so you say, what's the explanation? How come unemployment was so awful during the Hoover years because of these falling prices, but not during the 2021 depression? And the answer is because during the earlier depression, it was first Woodrow Wilson and then Warren G. Harding were the presidents, and they didn't do anything with wage rates. They didn't call businesses and say, don't cut your wage rates. They let business do what it normally would do to maximize profits and to deal with the situation. And so wages fell even more sharply than prices did for about 18 months there. And so obviously at the time it was very painful. It's not fun if you're a worker and your pay gets cut. But the point was unemployment spiked and then it fell down and things got back to normal. But during the Hoover years that didn't happen because he froze wage rates. Okay, so that's just one example of the sort of perverse things that happened back then. And again, to refute this idea that Herbert Hoover was this laissez-faire guy. In fact, one of the subordinates of Franklin Roosevelt, and this happened years after the fact, he was looking back on the 30s and he said words to the effect that, of course we wouldn't have admitted it at the time, but most of what we did under the New Deal was just an elaboration of the things that Hoover did under his administration. And just to give you some examples, Hoover had what's called the Reconstruction Finance Corporation. And that was this big institution that was supposed to bail out banks and other entities that were in trouble because of bad loans they had made during the 1920s. So again, perfectly analogous to what's going on today with the Federal Reserve and others bailing out U.S. financial institutions. All right, so one last thing on the Hoover years to show you, again, this myth that he sat back and did nothing. It was the free market's fault. He ran, at the time, unprecedented peacetime deficits. Right, so especially in the U.S., I'm not sure how much it carries over here in your guys' press treatment, but people say, what Obama needs to do is he needs to spend more, because during the 30s they didn't spend enough, they didn't borrow and spend enough in aggregate, demand fell, and that's what the problem was. Well, Hoover did try to spend. He ran unprecedented deficits. It didn't work. And in fact, FDR, Franklin Roosevelt, in the 32 election, campaigned on a balanced budget, and he told voters that Herbert Hoover was this reckless spender. Okay, so again, the standard story you get, at least in U.S. history textbooks, is completely reversed, because normally you would think that Herbert Hoover was a penny pincher and wasn't willing to spend money to fix the recession, when in fact it was the opposite, and FDR came along and excoriated his wild spending as being reckless. Okay, so let me switch gears now and talk about the current situation, so we can see that if the what's called the Austrian business cycle theory, if that analysis is right, and I try to give more evidence for that in the book, but I think most people intuitively understand that, yeah, it doesn't really make that much sense. If we all sort of agree that what happened during this recent boom was people, for whatever reason, and there's all sorts of explanations, it's not just the Fed, there's Fannie and Freddie Mac, which are institutions in the U.S. that encouraged home ownership for people that weren't really qualified. So you had all these horror stories of people getting mortgages that didn't even have a job. They would just fill out the application and make up a salary and they would get it. And part of the reason you had unscrupulous lenders, because the idea was once the boom was set in motion, lenders thought, I mean, they're not stupid, they understood what was going on, but the idea was they didn't really care because they thought, okay, as long as these homes keep appreciating at double-digit rates, even if this person defaults on the mortgage, so what? We'll kick them out, we'll take over the property, and we'll still be fine because it's, you know, appreciating, it's going to be worth more than the loan. So of course all that blows up in your face when home prices start falling. And part of the intellectual error, you know, what was driving this is that the models that a lot of these organizations use, the credit rating agencies and so forth, they looked at real estate markets and they assumed that, sure, any individual real estate market could change, but that its change wouldn't be correlated with any of the other ones. And so these mortgage-backed securities and these fancy derivative products, what they basically did is you would take bits of mortgages from all over the country. So, you know, thousands of people around the country would take out a loan from a local bank, buy a house, and start making monthly payments. And then, you know, through various intermediaries, people would buy up all those mortgages from around the country and then slice them up and sell them off to different investors. And so the idea was for the things that were rated AAA that were supposed to be very, very safe, the reason these computer models said they were safe is because this individual, you know, entity, it's getting streams of payments from all over the country. And so the idea was that, sure, maybe the Miami real estate market will tank, or maybe, you know, San Francisco will tank, but the whole country's not going to all go down by 10% in the same year. That's impossible. That would never happen. That was what was the assumptions in these models. And of course, that is what happened. And so that's why all these models blow up in their face. All right, so, you know, again, there's all sorts of factors that contribute to this. I don't want to say it was just the Federal Reserve, but the idea is in order to get this boom going in the first place, I think, you know, it really took the fact that the Federal Reserve was pumping in billions of dollars that it was basically creating out of thin air. All right, so the situation, you know, where are we right now? The U.S. situation, I think, is very bleak, and I tell people this, and they look really glum and despondent, and I'm sorry that that's my opinion, but you know that's what it is. It is what it is. So let me just very briefly outline why that's the case. So in terms of just the overall spending, the United States right now, the forecasts that they have, the Obama administration came out with its 10-year fiscal plan a few months ago, and then what's called the Congressional Budget Office came out and they sort of vet it, and they had their own analysts look at it. And incidentally, this is called the CBO, the Congressional Budget Office. They're notorious for being very optimistic about stuff. So when George Bush first came in, they were projecting $1 trillion surplus over the next 8 years, and of course that didn't happen, right? So now, but anyway, this CBO, so who has a record of over forecasting government revenues and under forecasting government expenditures, so erring on the optimistic side. This same group, they're looking at the Obama plans, and they're forecasting that the lowest the federal deficit is going to get over the next 10 years is something like $600 billion. It's going to dip down. That's the lowest, and then for the rest of the period, it's going to be above that. And there's several years where they think it's going to be above $1 trillion. Okay, so that's just the deficit, how much the government is spending beyond what it takes it in taxes. They think there's going to be several years over the next 10-year period that's over $1 trillion. Overall, they think it's going to double the U.S. federal debt as a share of the economy from about 40% to about 82%. Again, just in a period of a decade, doubling the size of the U.S. federal debt compared to its economy. So that's a pretty bleak statistic right there. But beyond that, I can't express. I know some of you watch U.S. affairs, but living there, it's really just how much the Obama administration is trying to do, and it's not just Obama. The Bush administration did this too, in their waning days. The allegedly free market George Bush was authorizing, literally taking over some of the banks and things like that. But since they've been in there, they literally own large portions of banks. That's fairly unprecedented. But even back just 6 months ago or so, when this was called TARP, the Troubled Asset Relief Program, was when they had $700 billion